From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Hello, it's Friday, August 30th, 2019. You're listening to the Hamilton Place Strategies Macrocast. I'm Tony Fratto from HPS in New York City, and Brendan Walsh and John Fagan with Markets Policy Partners are in the studio in Washington, D.C. Guys, we're heading into Labor Day weekend, and I feel like all summer we've been sort of waiting for that slow week, a slow summer week with not a lot happening. And maybe we kind of got that this week, but it's not like nothing happened. Heading into last weekend, it looked like chaos going into the G7 meetings with, tweets and recriminations in all different directions, a real, heating up of the trade war. Not a lot consequential came out of the G7 meetings. Even though it was a weekend where the new tariffs on China are actually going to be starting this weekend, it seems like there's some hope for a bit of a thaw. There's talk about there are going to be talks in September. There were some phone calls, maybe real or mythical, that seemed to have calmed markets. But we still have yield curve inversion. We have Argentina entered default again last night. We had the former Federal Reserve President Bill Dudley shaking things up with a weird take on what the role of the Fed ought to be. And then I know we have some Brexit. There's some Brexit news too, and so we want to spend some time on that. But what'd you guys make of the week?
Well, I think as you said it out, a lot of stuff happened this week, but compared to some of the other developments earlier this month, the volatility degree to which volatility increased across asset classes earlier in the month, this passes for a quiet summer week, even though so much went on. But
I have to recalibrate.
Yeah, going back to what you said about U.S.-China trade, clearly the tone has shifted to a more constructive engagement appears to be on the minds of both Beijing and Washington here. It was an important thing for the Chinese Commerce Ministry spokesperson to come out earlier this week and specifically say that they're seeking a negotiated solution and they're going to be holding back from retaliation to the latest round of tariffs. President Trump echoed the appeal to calm negotiations, and yesterday President Trump said that the Chinese want to and have to make a deal, and I think that lots of traders on Wall Street believe that very same thing applies to President Trump. When they look at the state of the U.S. economy, he obviously wants to shore that up for his reelection, and they don't think a full-on knockdown, drag-out China-U.S. trade war is compatible with good election prospects for the president.
And going back to Argentina, it kind of makes me think of Brexit, where the efficiency in markets. So in Argentina, we had a populist government who got them into trouble, and then they were thrown out of office, and a more market-friendly president was elected, implemented a bit of austerity, and then was coming up for election. And we had this primary where apparently the market priced in zero odds of Fernandez winning. And when he did, the market went down 50% on the day. And 2 weeks later, now we're in default. This kind of makes me a little bit worried about Brexit, where maybe the market just is assuming the worst case scenario is not going to happen. And maybe what we see here priced into the market isn't actually what's going to be priced into the market if we do a hard Brexit. I'd be interested in your take on that.
Yeah, hard Brexit is anything political is so hard to price in. That's well understood on Wall Street that political and policy outcomes are very difficult for the market to accurately price in ahead of the event, particularly with something that's binary. But it doesn't necessarily, things like what you bring up in Argentina, that's another shovelful of dirt on the grave of the efficient market hypothesis, right? Yeah. It's just like...
I mean, it's an emerging market, right. So it's not a perfect correlation. But I was just shocked that zero odds were priced in to Fernandez winning, and now we're literally in default. The 100-year bond is now trading at 39 cents on the dollar. And when they sold it a few years ago, it was 3.6 times oversubscribed.
Yeah, in some ways, the fact that the bonds are now pricing in, very high, if not a full on default, given the kind of recovery on defaulted bonds, I guess, is high 30s, sort of low 40s on
normal
a historical basis. And given that's where the pricing is, maybe that signals that the worst is over and that at least the bonds stabilize. I don't know if the same could be said about the peso, but
right.
It's at least an acceptance of a very worst case scenario. The rating agency S&P put Argentina's bonds across the spectrum in selective default last night, so it's pretty widely accepted.
Yeah, you wonder why markets didn't price that in 3 or 4 years ago when they're selling the bonds, right? I mean, I joked, well, we do know Argentina is going to be there in 100 years. It's not going anywhere, so that's the nature of sovereign debt. We also know that over the previous 100 years, I think Argentina has defaulted, I don't know, 7 times or so. Yeah, so
well, it speaks to the when you see things like everybody always says after the fact, well, how could Wall Street not see this coming? And I think that's that's sort of a unfair criticism, because when you get these issuances like a 100-year Argentine bond, so many people on Wall Street sort of have that nervous laughter moment where they say, oh boy, look at that issuance. That's kind of indicative of maybe toppy market. It speaks to that the lack of yield that's out there, and people are just reaching for yield, and a 100-year Argentine bond offered yield.
Yeah, anywhere you can get it. Yeah. Brendan's point though about how markets are trying to interpret the official sector and what obviously we saw that. I mean, we saw that with China last week. I mean, this was honestly one of the weirdest. That was one of the weirdest episodes in that it wasn't just that Trump, had talked about these imaginary phone calls of Chinese reaching out begging for. And the staffers
have admitted that he made it up so that the market would stop going down. So we're not even playing around anymore. We're just being honest about it.
And this, he interpreted Liu He's, comments about, which were really kind of perfunctory comments about, wanting to have negotiations based on, mutual, needs and not, taking the heat off.
Yeah. Calm negotiations.
It was just sort of a throwaway line answer to a question where at a public event that that Liu was participating in. It was not a fig leaf. The president comes out and calls it a fig leaf and treats it like a fig leaf. And you think, and a lot of us who are watching saying, well, there were no really weren't any calls. That really wasn't a fig leaf. And yeah, it kind of worked and calmed things down. And I think Brendan, you made a point that because what that at least did is send some signal that not that the Chinese were seeking a calmer environment and negotiated settlement, but actually that Trump was seeking a some more calmer negotiations. Whether that's true or not.
Equities have been up very sharply this week. It's the best week they've had, certainly in all of August, U.S. equities, and we're finishing strong here on Friday. There's some expectation, or maybe it's not expectation, but some hopes or some speculation that the president might delay the tariffs that are supposed to be implemented as of September 1st. As in the midday on Friday or after the trading session, it would certainly not be uncharacteristic for that kind of swerve to happen just before implementation of this newest round.
Has there been any rebalancing out of sort of rotating out of we saw obviously the massive rush into bonds, and was this week any people were bonds oversold a bit and some of that money coming back into equity? Is that possible? That
it was pretty low volumes all week.
Well, one of the things that we have seen is the Treasury market. What we talked about so much was not last week but the week before about the inversion of the yield curve. The 10-year yield sinking below the 2-year Treasury yield, and the consequence, basically the significance of that, the fact that it's a traditional harbinger of recession, and that the initial event when it happened was shocking to markets and risk assets sold off. But it has persisted. It's still negative, and it's still inverted. But everybody's now, it's less of an event, and the kind of shock is worn off. And we saw this week, even as U.S. equities rallied very smartly and reduced the, I guess now they're only 3+% off of all-time highs from late July. That's a pretty modest downside after the rally that we've seen this week. And Treasury yields have only been able to edge upwards. So there's still a lot of, it seems as though investors have been looking for this bond rally to reverse a little bit, the overbought, the very steep decline in yields to arrest and maybe yo-yo bungee jump back up. But it's been a very limp kind of rise in Treasury yields so far this week.
One thing we know drives Trump bonkers right now is the dollar remaining strong. Dollar strengthened this week, which he seems to think has something to do with other countries trying to cheat us, but really probably has more to do with weakness in places like Europe and China and the UK. What do you make of that?
Yeah, the dollar had a pretty big move this week if you look at it on a broad dollar index basis. And it's back up not to multi-year highs, but certainly close to the highs of the year. And it's, as you say, there's the distinction to be made between what's dollar strength and what's weakness in its peers. And that's an important distinction to make. As the euro obviously is getting a downdraft from consistently poor economic numbers and expectations that the ECB, the European Central Bank, is going to be coming in with a pretty muscular easing package on September 12th. And the Bank of England, obviously, as Prime Minister, we'll talk a little bit more about it later, as Prime Minister Johnson, with Prime Minister Johnson at the helm as the ship of state sort of careens toward a hard Brexit, the pound is certainly languishing near multi-year lows. The yen, there's some expectation that the Bank of Japan, as we've said before, it's not a central bank that likes to be outdone. It's probably going to be coming in, and the dollar strength is basically the fact that the others are weakening against it.
Yeah. Maybe this is a good time to take a break for ad. But Tony, you said that in 100 years Argentina is still going to be there, but will the UK still be there? Maybe it'll just be England and Wales.
In its present form, it might just be England and Wales. Scotland and Northern Ireland may go their own way. Yeah, why don't we take a break? We'll come back and let's talk about BoJo's big week and Brexit. You're listening to the Macrocast.
Markets Policy Partners provide sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com.
Okay, we're back with the Macrocast. Tony Fratto, Hamilton Place Strategies in New York City this week. John Fagan and Brendan Walsh in the studio in Washington, D.C. Guys, Prime Minister Boris Johnson did a weird, I don't know if it's unprecedented. I'm not aware of it, sort of happening before, certainly not for these reasons, but essentially, initiating efforts to close up Parliament, keep Parliament out, it's like a lockout of Parliament, so that they don't screw up his plans for a hard breakfast, or at least Brexit, or at least,
or maybe just a breakfast too.
Yeah, maybe breakfast too.
He's a quirky guy.
Or at least not to screw up what he sees maybe as his negotiating position with the Europeans going into the October 31st deadline. So Brexit is back in a big way this week. How do you think that's going to play itself out?
When the announcement first came out that he was engineering this suspension of Parliament, and very quickly the Queen accepted his request for her to do the speech, dragging the Queen into it. Prime Minister Boris Johnson certainly has a lot of,
years old.
He's got a lot of
chutzpah.
Temerity, chutzpah.
So she has to give a speech, right? That's part of this deal.
Yeah, he said that it was going to be a speech and a grand opening of his new government to showcase his exciting agenda. And I think hard Brexit would be exciting. I think that's
would be very exciting. Yeah.
So when looking at when market participants analyze these events, the first thing they do is look at the pound. How did the pound react? The pound is the primary market-based barometer of the day-to-day high-frequency fortunes of Brexit, and the pound fell about 0.5% against the dollar, which isn't really, it's not a swan dive by any stretch of the imagination.
But that's off a pretty low, historically low trading range right now, isn't it?
That's right. It's really down by multi-year lows. The key level of $1.20 is where the pound has bounced off of again and again, and it's really been knocked on the door of that level earlier and bounced back up. When you look at CFT positioning data, which means, how concentrated are the bets on one side of a currency or the other, appreciation or depreciation, the CFTC data shows that there are heavily one-sided concentrated bets on more depreciation. So when you have such heavy positioning, it's hard to get a push sometimes it's hard to get a push in further in that direction. And we saw, the pound kind of pop up 2% just because Boris Johnson went to Europe and didn't get drinks thrown in his face at at last week's set of meetings. So the pound it's a good indicator, but it may not be. You always want to look at other market prices to see where Brexit is. And one of the key ones that everybody's looking at now are the market implied odds of a Bank of England rate cut. Everybody assumes that if there's a hard Brexit on October 31st, the Bank of England is going to cut rates. And the odds shown in the markets are, around 50% chance of a rate cut by year end. And so if you go in with the assumption that if there's no Brexit, they don't cut rates. If they have a hard Brexit, they do. That's about 50-50 odds on Brexit shown through the sort of interest rate futures markets there. And that actually comports with what UK bookies are putting on odds of a Brexit by October 31st.
Indicator,
yeah, the bookies, they tend to have pretty good odds. Although they lost their shirt on the initial Brexit vote, all the bookies got cleaned out on that one.
Yeah, I always get confused exactly what's ironic and what's not, and that's just funny. But I do think it would be ironic, technically, if it's Brexit that reunites the Northern and Southern Ireland.
It's
look, that's the story on this. I mean, if you're trying to imagine how this might play out, and whatever Boris Johnson's goals are to try to maybe to squeeze some kind of further concession out of the Europeans, although they seem to not be willing to budge at all. It really comes the biggest issue, the most sensitive issue, not just economically, in fact, maybe even in some ways less so economically than it is culturally and politically, is the prospect of a hard border on the Northern Ireland and Republic of Ireland border. And I don't see any solutions to that, and no one else seems to have come up with any solutions to that make any sense. And I'm not sure what anybody expects the Europeans to do about it. It's not like they can just allow a back door into the EU. That's not.
I mean, I've been there. It's just farmland, and if you put up a wall, you're bringing back the Troubles.
It definitely doesn't seem like there's the Europeans are not necessarily opening the door particularly wide to a renegotiation of any of these points. Just as you said, Tony, it sure doesn't sound like they're, Angela Merkel and the others are ready to put a bunch of these previously agreed with the previous government under Prime Minister May. Those arrangements, they just don't want to reopen it.
No, they don't. And I think they did feel like they were going as far as they could probably go. And this isn't the first run. This is like the fourth run at these kinds of negotiations, going all the way back to then Prime Minister Cameron's pre-Brexit vote deal to try to elicit some concessions in the relationship, and that envisioned the UK remaining in the EU. So they've been through multiple rounds of this. They had at the G7 last weekend some well-staged bilaterals between Boris Johnson and Angela Merkel and the other European leaders who were there. I had to remember who the Italian was. Not that it mattered. Although Conte looks like he's back.
I know.
But neither the French nor the Germans look like they're have any interest in further concessions. The reality of the situation is what it is, and look. Maybe this is time for us to lay down odds on this. I'll be surprised if there is not a hard Brexit.
Yeah, I'm with you.
And I expect it to be messy.
Yeah, I just don't see a solution.
Right, and markets obviously are not not fully priced for a hard Brexit, but certainly when you look under the hood at the more systemic risk indicators in the UK, like credit default swaps, which is the cost to insure against default in the sovereign bonds, those are not at scary levels right now. The credit default swaps on subordinated debt for Lloyds Bank, which gets all its revenue from UK domestic business, those are also not at stressed levels. And so if you look at markets, they're assigning about 50-50 odds to a hard Brexit, which is probably too low. The pound looks like it's going to take the brunt of it, and it doesn't right now look as though markets are expecting this to be a systemic problem. So not a bang, but a whimper.
But I understand that it doesn't have to be the end of the world overnight. But in my previous job, I spent a lot of time in London and covering the financials over there. And when you go to London, pretty much everyone works in finance. There's not much else. It's kind of tourism. And if you do the hard Brexit, you lose your passporting rights. And I just don't understand how the bulk of these jobs can stay in London. They're going to have to, and they are slowly migrating to the continent. But I think if you do the hard Brexit, what's still there is the bulk are going to have to move over.
Yeah, look, maybe on the pieces of previous agreements on this are still, there's the May plan is still sitting there. Maybe you could take pieces of it that will work in extremis if you're within days of Brexit. But I just don't see a full package solution on this until they're absolutely forced to do it. And it's, look, even after Brexit, you could have a hard Brexit and you could experience the pain of it. And then that puts you in a position of negotiating in a more focused way. But
yeah, it's a good point.
Yeah, so we'll see how that goes. It is the never-ending story, and so I have a feeling we'll be back talking about it again. But why don't we take our last break now, and then I want to come back and talk about this, this silly op-ed by former New York Fed President Bill Dudley. You're listening to the Macrocast, and we'll be right back.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
Okay, we're back on the Macrocast. So guys, former New York Federal Reserve Bank President Bill Dudley, who's a guy I have to say I always liked him as president of the New York Fed, and thought his speeches were always interesting and had some good insights. And but he came out with an op-ed this week, and the controversy in it is that he raises the prospect that that the Fed ought to consider politics in a way, or at least the way that an administration is executing policy in ways that could damage the economy, and that it should be active in trying to prevent those kinds of actions by the government. He introduced a very political sensibility to the job of the Fed, which I think since the Federal Reserve's inception in the early 1900s, and the idea of an independent Fed was that it rests on a non-political and apolitical sensibility, that it observes what the government is doing, but doesn't enter into the fray of the actions of certainly not on the fiscal side and not on the the policy making side, and that it reacts that way and trying to meet its mandate of low inflation and maximum output. So this caused a lot of controversy. Did you guys hear any of this from in markets? And do you have a view on whether he should have said this, and whether it's what the risks are of him saying this?
But you're totally right. I mean, since Arthur Burns and Nixon, the Federal Reserve, everyone that's been involved in it since then for the last 40 years has spent all their efforts to maintain Fed independence and credibility. And Donald Trump is making markets a little worried that he's going to be able to crack that. But then Dudley comes from the exact opposite side and is almost attacking Fed independence and credibility, saying that we shouldn't have, we should not just focus on our dual mandate, but now take into our own political views. So I don't think we saw a big reaction in markets amongst market participants. There's been a very large negative response to it, I suppose.
Yeah, I think I would say from a couple of points. One being, if one of the points that Dudley makes is that in the op-ed is that the Fed appears to be playing along, and if the Fed were really playing along and Chair Powell were such a pushover and so forth to the Trump agenda, then maybe the Treasury yield curve wouldn't be inverted.
Right.
It's the Treasury markets certainly don't show that the Fed is being irresponsibly loose with monetary policy.
The exact opposite, right?
At this point, it's sort of an incompatible. It's incompatible with the Fed being completely compromised. Dudley didn't make the point. He didn't say that the Fed was completely a puppet at this point, but he certainly was making comments in that direction. But I think also from a market perspective, it's irrelevant. It's sort of an irrelevant argument to say the Fed should come back and choose which political and which policies that it wants to support and which one it doesn't. Because if this Fed came out and said we're not going to facilitate this trade war and we're going to withhold easing, that because we don't want to encourage this what we believe is a wrong-headed policy, they would find themselves easing for another reason, which is that after they said that, the dollar would spike, the Treasury markets would invert heavily, and the S&P 500 would fall precipitously. I would imagine.
For every action, there's an equal and opposite reaction.
Then they would find themselves easing not because of the trade war, but because financial conditions in the U.S. are tightening so dramatically because they made this.
That's a tremendous point.
Yeah. I think I understand the frustration if you're sitting over at the Fed, and the frustration if you feel just as a matter of economics that the actions of an administration, and by the way, it doesn't have to be this is trade war. I mean, we know Federal Reserve, the Fed has had concerns sometimes about tax policy and spending, and lots of things that they can have concerns about. But I think it's fair to say that they're exceeding their mandate if they're thinking about those kinds of things. I mean, that's the price they have to pay for independence, and I think it's that's a price well worth paying. So what are we looking at next week?
So the week will start off with the focus on manufacturing. So in China, we get two important PMIs, which a PMI is a Purchasing Managers Index, where they survey the purchasing managers for manufacturing. So it gives a good sense of the health of the manufacturing. So in China, we get an official one on Saturday and then a private measurement on Monday. And then on Tuesday in the U.S., we'll get the U.S. ISM for August. So this will show how well the manufacturing in both China and the United States did in August. And obviously, this is a pretty good indication of how much the trade war is negatively affecting the economy. Then midweek, in Australia and also Canada have rate decisions. And while both are not expected to cut it this week, the market is pricing in a number of cuts over the course of the next 6 to 12 months. But then the week closes on Friday with the all-important U.S. jobs report, which I know that Hamilton Place does a wonderful analysis of. So what we're looking at is about 155,000 expected, and for the unemployment rate to stay steady at 3.7%.
We will definitely be talking about the jobs report next week. I mean, I think it seems like every month it's the mother of all data points, and
it's by far the most important global data point.
And so we'll dive into that again next week, and maybe we'll get into the guts of the jobs report a little bit next week, too. But for this week, that's all we're going to have for you. So for John Fagan, Brendan Walsh from Markets Policy Partners, and Tony Fratto at Hamilton Place Strategies. Thanks for tuning in to the Macrocast. We'll be back with you next Friday, Jobs Day Friday. And in the meantime, have a wonderful Labor Day weekend.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.